All right, welcome again, everyone. Our next presentation is from Bernard Tan, Chief Executive Officer at RE Royalties, which trades on the OTCQX market under the symbol RROYF, as well as the TSXV under the symbol RE. So welcome.
Thanks, everyone, for attending the conference today in person and also online. My name is Bernard Tan, and I'm the CEO and co-founder of RE Royalties, the first royalty company focused entirely on the renewable and sustainable energy sector. Our symbol is RE on the Venture Exchange and RROYF on the OTCQX. Before I begin, I would like to point out that this presentation will contain some forward-looking statements, so please refer to our regulatory filings for more information. Our financial statements are also prepared in Canadian dollars, so the currency in my presentation today will be in. My presentation will also cover a couple of things: an overview and background of who we are, a snapshot of our portfolio, and also our recent financial results. The market opportunity and how the royalty business can really take advantage of some of these opportunities, and then wrap up with our plans for the next 12 months. Our vision and objective at RE Royalties is quite simple and straightforward. One, to generate strong economic and long-term returns for all our investors, and two, to really help build a cleaner and more sustainable future. How we set to accomplish this objective is by acquiring a portfolio of growing, long-term, stable, and diversified royalty streams from operating and late-stage renewable projects that will provide our investors with resilient, sustainable, and growing long-term cash flows. We aim to provide the trifecta of investment: a strong yield, high growth, and clean sustainability. A little bit of background of who we are. We started in 2016. In that year, we recognized really the opportunity to apply a well-proven royalty business model to renewables, where royalty financing just did not exist. We saw similar parallels to the exponential growth of royalty financing in the resource sector in the similar to what we saw in the resource sector in the mid-2000s, which really established the billion-dollar royalty giants of today, like Franco-Nevada or Wheaton Precious Metals. In November of 2018, we took the company public through a RTO listing on the Venture Exchange, and as of last year, our shares also trade on the OTCQX. Our goal is to be the premier royalty company in the renewable and clean tech sector. To date, we have raised over $68 million and invested that into a portfolio of royalties on solar, wind, renewable natural gas, battery, and energy efficiency projects in Canada, the United States, Chile, and Mexico. We are also a growth-oriented company. In 2021, we were named as one of Canada's top growing companies by the Globe and Mail. We've realized year-over-year growth of 128% in the first 3 quarters of this year compared to last year. We have invested over $37 million in the last 2 years alone, which will further fuel our future growth going forward. Earlier this year, we also raised $18 million in green bonds, and currently we have roughly about $10 million in unallocated cash and over $40 million in signed term sheets in our backlog. This will help us continue that growth trajectory into 2024 and onwards. Our investments also meet several of the UN Sustainable Development Goals, as the impact of our investments generate a significant amount of clean energy per year and reduces a large amount of greenhouse gases. For those investors looking for a pure play impact investment with a current 7% dividend yield and a strong growth profile, we check many of those boxes. This is sort of a quick snapshot of everything of our portfolio. To date, we have made over 70 million in investments across 21 different completed transactions. We currently own a portfolio of 113 royalties in solar, wind, hydro, biogas, and energy efficiency projects. By dollar value, approximately 39% of our investments are currently in solar, 25% in batteries, 13% in wind, 11% in energy efficiency, 9% biogas, and 3% in hydro. These royalties have a remaining life ranging anywhere between 10 years all the way up to 30 years and will bring in about $26 million in new cash flow with no related costs. To date, our investment portfolio has generated an IRR of 19% on an unlevered basis. In terms of geographic concentration, our investments are primarily in Canada and the US, with a smaller percentage in Chile and Mexico. In Canada, our investments span several provinces like British Columbia, Alberta, Ontario, and Nova Scotia. As previously mentioned, our investments also meet several of the UN Sustainable Development Goals relating to clean energy, resilient infrastructure, sustainable communities, and climate action. The projects in our portfolio currently generate approximately 400 megawatts of clean energy capacity per year, which is enough to power 133,000 homes and abate over 421,000 tons of greenhouse gas emissions. This is a very detailed list of all the transactions that we've done over the last 5 or 6 years. I won't go into the details of each, but wanted to point a couple sort of highlights. Most of the royalties we generate come from projects that are already in operations or currently in construction, which means immediate or near-term cash flows to the company. The other aspect I'd like to also highlight is also who operates these projects and who pays the royalties, which include some very strong investment-grade utilities like BC Hydro, Hydro One, Nova Scotia Power, or Green Mountain Power, which really highlights the resiliency and credit strength of those cash flows. A quick snapshot on our capitalization and financials. We currently have about 43 million shares outstanding with a market cap of roughly about 27 million. Insiders own about 25% of the company, so very strongly aligned with shareholders. The remaining 75% are held by institutions, a couple institutions, but primarily family offices and accredited investors. In 2022, we raised 18 million in green bonds and equity, about a 10 million bond versus 8 million equity split, and we've fully deployed that capital. In 2023, we issued another 18 million in green bonds earlier this year, in the first half of this year, with a term of 5 years and 9% per annum in terms of the interest. We're currently sitting on approximately 10 million in cash that's not yet allocated, so we do have some dry powder to be able to invest in the coming weeks. And we expect to fully deploy those funds really, I would say in the next 1 to 2-ish months. For the first 3 quarters of this year, we realized approximately 7.2 million in revenue and income. And once our cash is deployed, we expect an annualized revenue run rate in the 9 to 10 million range, with an EBITDA of roughly about 7 to 7.5 million. As you can see on the bar chart on the right, despite all the issues in the market relating to whether it's the pandemic, geopolitical events, inflation, we have been able to deliver very consistent and resilient growth in our revenues and income, and also cash flow over the past 8 quarters. As you can also, one of the things as a venture and OTC company as well is we also pay a dividend roughly of 4 cents per share per year, which at the current share price is about a 7% yield. And that dividend is paid on a quarterly basis. In terms of the market opportunity, really, how large is this market opportunity? As many of you know, climate change, energy security, resiliency has been and will continue to be a major economic driver today and also into the near and long-term future. Despite all these challenges that we see in the markets today, in 2022, we saw over $1 trillion invested globally in the energy transition, a 31% year-over-year increase compared to the prior year. This trend is expected to continue on an upward trajectory over the next few decades. And according to research by Bloomberg, investments will have to increase to over 4.4 trillion, that's with a T, per year if the world truly wants to reach its net zero goals. In short, this is a very large market and will continue to grow significantly. RE Royalties only need to capture a very small sliver of this long-term macroeconomic trend to achieve our goals. Renewables, by and large, is not a resource play, but rather it's a technology play. A lot of the growth in renewables that we see today are driven by underlying technology improvements. Similar to our smartphones and computers in the last few decades, the costs of producing and storing energy from renewables continue to drop year over year. Again, according to Bloomberg's research, that today, over 2/3 of the world's population live in countries where solar or wind are the cheapest source of new electricity. Many places, renewables can displace traditional coal and gas without any subsidies. So investing in renewables is fundamentally an investment in technology and human innovation. In terms of why we like the royalty model, I'm not going to go through each individual point, but this slide really highlights some of the advantage of why we like this business model. This is very similar to what you see in the oil and gas or mining industries with some great companies like Franco-Nevada, Wheaton Precious Metal, or Freehold Royalties. The key takeaways that I like to point out is that a lot of times royalties are based on gross revenues. So this helps shelters our cash flow from unpredictable factors like rising taxes or an increasing cost environment. Another beauty of a royalty company is that our costs are relatively fixed. So by growing our top line, we don't actually have to grow our costs. We have a fairly small team, roughly about 10 people, and we can grow from where we are without having to add a lot more overheads. We also don't need significant construction or sustaining capital to get an asset operational in order to generate those cash flows. So we can actually size our investments to the capital that we have. We can also achieve cash flow diversification much quicker. We spread our investments over multiple projects in multiple jurisdictions in multiple technologies. And as most of you know, the royalty business model is well utilized and well proven in many industries except renewables. Being a first mover allows us to access some of the best opportunities for royalty financing. So what do we invest in? We only invest in renewable and sustainable energy projects. We don't do any fossil fuels. Projects that can help mitigate climate change and offset greenhouse gases. We like proven technology, and we do have a bias for operating projects or those that will reach operational status in the very near term because we like cash flow. In terms of where we invest, we like geographical diversification. Part of that is politics can be quite unpredictable. And also, it's also because electricity does not trade like a global commodity, even though every electron is the same. Markets can be very regional, and we want to diversify our risks across multiple places. Our targeted returns are generally in the 10 to 20% range, which allows us to support a strong yield to our shareholders and also drive growth. Our goal is to ensure a diversified portfolio of royalties from across jurisdictions and technologies. In terms of how we invest, there are two main ways that we do so. One, for about 20% of our investments, we acquire long-term gross revenue royalties, typically 15 to 20 years. And the second way, which is about 80% of our portfolio, is we utilize a short-term loan and acquire a long-term royalty. This is really our favorite product because it allows us to recycle that same dollar of capital. To illustrate using the step chart that you see on the right, you can see that based on a 3-year loan term, we can lend that same amount of capital 7 times across 20 years and create 7 different royalties from that same dollar of original capital. That power of compounding helps use the same dollar to drive an upward curve on our long-term cash flows. Recently, had a lot of questions on, how has geopolitical events globally or inflationary factors affected the business. It's actually affected our business positively. And part of that reason is really what we're seeing as a result of all these geopolitical uncertainties is that countries across the globe, provinces, states, have been looking at energy security and resiliency as a long-term strategic goal for them. This has encouraged a lot of favorable policies like the Inflation Reduction Act in the US and the recent Clean Technology Investment Tax Credit in Canada. So a lot of these companies are looking to bring back onshore a lot of their energy security policies. And it's really encouraged a higher adoption of renewables and clean tech and really opened up a lot more opportunities for us on the royalty financing side. In terms of inflation, the inflationary conditions obviously have resulted in a higher cost of financing for ourselves, as reflected in our green bonds, and also for our clients. However, one of the things that we're also seeing by this higher cost is that some of our clients are also realizing higher revenue because there's a much higher demand for renewables. To a certain extent, even though our green bonds have moved from 6% per year in 2021 to 9% this year, we've been able to pass some of that cost over to our clients, and they've been able to absorb it without undermining their own margins and ours. The other aspect that we've seen is that because of these inflationary conditions, we've seen actually less competition. Our deal flow and backlog has, I would say, exploded and increased quite substantially in the last 2 to 3 months as a result of these conditions. So here's, in terms of the deal pipeline, in the past year alone, our team evaluated roughly about $1 billion in opportunities. These opportunities come from existing and new clients and also various advisors that we work with in the industry. Approximately 20% or 200 million pass through that initial screening stage to the second phase where we conduct more detailed evaluation. So currently we are actually looking at approximately 200 million in deal flow that's currently in this stage. The sort of table on the right is a quick snapshot of the types of opportunities that we're currently seeing and where they're located. The third phase, once we get through this 200 million, is we then execute a term sheet and we put terms on the tables for our clients. We do detailed due diligence, site visits, legal documentation, and we currently have about 40 million in this stage alone. Most of this is with existing clients or clients that we've worked with in the past. And out of this phase, historically, we've closed about 60 to 70% of this deal. This backlog gives us a very strong visibility of putting our existing cash reserves to work, which will then further drive our top line and bottom line. In terms of our next 12 months, our primary focus really is to deploy that remaining 10 million cash on hand, and we do expect to complete that sort of in the next month or two. Once deployed, we expect an annualized run rate of roughly about 9 to 10 million in terms of a top line, EBITDA of roughly about 7 to 7.5. In terms of funding, because we do get this question given we do trade, is our immediate plans are really to look at potentially a future green bond offering or co-investment partnerships with larger institutional investors to get through our backlog. We have a very small team, roughly about 10 people, of which a third is actually at the conference in person, and I think the remaining might be watching online. Most of our team members have a mix of royalty, engineering, renewable energy type of backgrounds. I want to say that two of the management team and one of our board members are also a part of Canada's Clean 50 sort of annual winners. So definitely have that track record. Again, quick snapshot of our board members. So really, what are the key investment highlights of RE Royalties? It's a very unique, high-value growth and impact investment opportunity because we're deploying a really successful royalty financing model into a large and rapidly growing renewable industry. We create value for investors by being a first mover using a proven business model. Number two, we provide a strong risk adjusted return by investing in lower risk operational projects while securing higher development style returns. We grow our portfolio through reinvestment of capital to create new royalties, and we also protect our investment by employing a combination of strategies such as being senior secured, over collateralized, and diversification. Finally, we have the right team to make this all happen. I thank you for your time today in attending my presentation. And I also want to thank Water Tower Research and the OTC for hosting and putting together this great event.
Bernard, we have a few minutes for questions now. Sean, coming right over to you.
Hey, Bernard, I'm wondering what draws the projects to you. I mean, obviously there are huge advantages of having the royalty model for you, right, for the company and for shareholders. But what is it that gets you such a big pipeline and so many looks at investments?
I think a lot of it is really sort of the unique structure. I myself come out of the mining royalty sort of space, and even though most of our clients I would sort of classify in the small to medium enterprises, where capital can either be expensive and flexible, and we provide that sort of flexibility. I would say we're not always the cheapest capital, but we can be the most flexible to really sort of adapt to each of our clients' sort of individual needs. At the higher sort of larger enterprise sort of bracket, and we have had a few discussions with larger issuers. Part of that attraction, if you look to the similar space like the mining space, large entities like Rio Tinto, Anglo American, they still use royalty financing as part of their capital stack, mainly to ensure they don't have dilution to their shareholders, or they're trying to take some money off the table to spend on higher return development projects. So it's really at the same sort of thesis that we provide, similar to many
others. Any other questions from the audience here? I believe we have some from our virtual attendees.
Bernard, we have a question about dividend policy, payout ratio, and expectations for 2024.
Yeah, that's a great question. I wish I could be more specific. Is sort of my so sort of rough numbers. We currently before dividend generate about 4.5, 5 million in free cash that we can use for dividends, buybacks, reinvestment. We have a wide range of shareholders that I would say are in different camps. So in terms of sort of dividend policy going forward, we're definitely on a very stable front. We do not expect to change it. Whether we increase it, whether we reinvest, whether we buy back, I think is still something we are considering as our board is considering, because it is one where where do you put the money to and where can you get your best return. So it's constantly under consideration, but currently we don't have any plans to change our dividend policy.
And there's a question here of just about your geographical footprint, and are you looking to expand in any particular countries?
I would say primarily most of our opportunities are still North American based. We are looking abroad. We have some partners that we do work with in the Latin and South American spheres. We've been active in Europe before, although right now I would say we're currently not overly active, simply because most of the opportunities we've high graded more towards Americas.
All right, Bernard, I know you're joining us for our afternoon panel, but thank you very much for now.
Thank you.